Hi, I'm Michael Gable, the Managing Director at Fairmont Equities. Much has been made recently of the poor market breadth in the US. That is, the US share market is going up only because of a few tech stocks, just a handful. And the implication is that this is a negative and that we need to be very worried. Well, let me put this into perspective for you. Remember, any advice is general only. Firstly, the rally in markets in the US. During the past 5 years, it's actually not that special. It feels like it's come up a long way, but as we could see here, the current market rally in the S&P 500, which is the pink line, it's actually nowhere near as crazy as the prior tech boom and the roaring 20. So just bear that in mind before you start thinking that there's something extraordinary about what we're seeing at the moment. Now, the next thing to look at is what the small caps are doing in the US. This is represented by the Russell 2000. So compared to some recent bull markets, it has lagged in a big way, and that's the blue line on this particular chart. So small caps haven't even moved yet. Now remember, in a typical bull market, the large caps generally move first, and then as the confidence improves, and this clearly makes sense, confidence improves, it starts to flow down to the mid caps, and then it flows down into the small caps over time. So if you remember back to the bull market that ended in 2021, only a few years ago, in the final few months it was the small caps, they were doing incredibly well while everything else was topping out. Remember, bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. There is a lot of pessimism, at least skepticism out there at the moment. We're nowhere near that euphoric state, and we can see that in the way the small caps are trading. Now, this chart here shows the large cap value stocks in the US compared to prior markets. Again, that's the blue line at the bottom, and it hasn't really moved yet at all. If anything, it's gone backwards slightly. So the point I'm trying to make is that worsening market breadth is a problem when you're at the end of the bull run, whereas these charts are showing us that the bull run hasn't really started yet, it hasn't properly started. So it means that when the major tech stocks in the US do start to sell off, we're likely to see the funds flow into other parts of the market. The void will be filled with the large cap value stocks, such as commodities, and then it'll trickle down to the small caps over time, which again, as we've seen, haven't even moved yet. So any impending sell-off in the US will likely be shallow as the rest of the market soaks up the liquidity instead. Now, if you're looking for more ideas, head to fairmontequities.com, sign up to the free trial. You'll get the trading guide on how to buy and sell shares, and you'll get 8 weeks of our research delivered to your inbox. And if you do qualify for our portfolio management service, give me a call and we can talk about how that works.